Hi, everyone, and welcome to the Goblin Hideout, the NFT Finance Podcast. I'm Terry, and I'm joined by my co-host, Ryan, otherwise known as Helmus. And today we're speaking with the Darius, the founder of DropsDAO, quite an anticipated episode on Twitter. So really excited to have you here today.
Yeah, thanks for jumping in, Darius.
Thank you for having me.
Really absolutely. To be here. Awesome. So I think probably to kick it off is maybe let's tell the listeners a little bit about your background prior to getting into crypto.
So yeah, I'm a developer and started my journey by kicking off with mobile apps development. So yeah, that was years ago. And I was running an agency we had like a small team that was probably like back in 2010, 2012, something around that. So that was going on for a while. And then I got my first, I think, like Bitcoin back in 2012, just like by going through forums and stuff and seeing how, I don't know, just like the idea of it sounded like really, really cool. And yeah, then I started digging more into it, but then it wasn't really more part of the whole crypto stuff until like later 2015 when Ethereum started to surface. So yeah, until then I was still working at my company, just building software and apps. And then when the whole ICO craze started off, so kind of got more attention towards it and decided to pivot my company towards Web3 development. And so back then we're just building the basic stuff like tokens, some dashboards. Not too many people were interested in building products except writing white papers and stuff. And then later on, I think in 2020, decided to start more independent work instead of being a contractor. And it started with Node Runner's NFT project, and it was done. We just airdropped a bunch of tokens to random people. This project was like yield farming with NFTs. It was like one of the first attempts to do something with them. And as it was going on, I was just asking myself what else we could do with NFTs, and what if NFTs could be interconnected with the whole DeFi ecosystem, like what would be the outcome of that. And also was thinking how to make yields, for example, how yields could be more sustainable for NFTs as well. That led thinking that we would need like this permissionless infrastructure for NFTs where they can be plugged into DeFi so that, let's say, instant loans can be obtained, and then like borrowed funds could be then like funneled into other DeFi protocols to start building these Lego applications on top of each other.
So was this like around this time? When was this? Like, was it over like a year ago, would you say? Or when you started like ideating around this?
Yeah, ideation, I would say like late 2020.
And then is this where you like started, like first had the idea for DropsDAO? And as a segue, maybe you can provide the kind of Alice and Bob example of how DropsDAO works in its current state?
Yeah, sure. So it works kind of like Compound just for NFTs, and has these isolated lending pools where basically we group NFTs by their risk profiles. So we have like one pool for Yuga Labs asset, then second one, say for art blocks, and the third one for mid cap, and fourth like for higher caps. The way it works, users are applying NFTs, and then we built Chainlink Oracle that determines its floor price value, and users can borrow up to 50% of its value. And that's the overview of it. Like in a recent development that we started is to go further, like what can we build on top of it. So one of the more exciting things is NFT mortgages. What that will allow is for users to buy NFTs from the marketplaces by doing only like 50%, 60% down payments, while the rest of it just gets financed by our lending pools. So since any collection can have its isolated lending pool, so it can scale pretty well. So like eventually we just plan to accommodate as many of NFTs as we can and can introduce this buy now, pay later model for NFTs.
Yeah, I definitely want to get into NFT mortgages later on. That's actually something that I've been interested in for quite a long time now. But I want to bring it back to the main, like the drop style protocol. Mainly when I think about compound and or like compound-esque models, I think of the three things that I want to know as sort of what is the data feed and how reliable is the data feed, and then number two as like what is the parameterization of the interest rate process, and then finally like what are the risk parameters, like how to determine LTV. I'd love to go through the three, but starting with number one, like what are your data feeds and how reliable are those oracles? And I know you guys have built like multiple redundancies in your own. Could you describe us sort of the data feed that you guys are using?
Yeah, sure. Yeah, we're using multiple feeds. All right, so the first one is the one like we built ourselves, and it's based on our like methodology of pricing. So I don't know, let's call it drops sales floor value. So what we're doing there is checking sales, what that are happening on the market, and then removing extreme outliers. And then after that, we're removing probable outliers. Like the algorithm there is similar to what we have in Bollinger Bands, like in trading. So there is this band within which we track sales as eligible. And if sales is there, so they go to like further process to calculating lowest sales swap. And well, if not, they just get filtered out. So this is the first one. The second one, our recent integration, it's with NFT Bank. So what we're doing there is, again, so there's a separate note for NFT Bank. We're getting 24-hour average floor value for the collection. And the third source, which is actually available only for CryptoPunks now, and Bored Apes, it's using TWAP of NFTX vaults. So basically combining either free price sources or two and doing the average of them. So if our server goes down, then we can rely on NFT Bank node. If their server goes down, their still collection can rely on NFTX. And currently we're also integrating, in process of integration, one more price feed. And I think like there is one more that we're also considering. So in the end, it's like really wonderful what Chainlink have built, because it just allows us to, each price feed would be hosted on separate Chainlink node. And just the more price feeds we get, and I think, in the upcoming year, there'll be definitely more of them. So the more it's resilient and the better we can do.
And just curious with the data feeds, so you'll be integrating with soon to be 4. Is there like a priority, or I might have missed this, but was there like, do you use an average when they're all live and up?
Yeah. So it's possible to use weighting for them, like to set different weights. But for now, we just set them equally. So it's an average of them.
I think you launched your own Oracle, I guess it was like around last November. And I think potentially this was just me kind of going through some of the research, but you ran into some issues. I'm just curious, like what are some of the flaws that you saw in that?
The primary issue was to kind of detect basically the manipulation attempts when sales would go much lower than the floor value. Basically, that was the primary thing. We're trying to research like different ways how we can just filter out those sales that are low probability of happening. So we even like try to apply machine learning models. That would require a much deeper scope of work that we initially anticipated. Also, the issues we have when we try to apply just the floor model for collections, like there could be attempts to set lower floor for a very low period of time. So that's also something we had to figure out, how to just filter the data and average it out so it's just more smooth and usable in Oracle. But like eventually, with help of some data scientists, that we consulted with, we managed to come with more reliable model. Then we back tested it. I know, ran through past year transactions, and yeah, it started to look more consistent. And eventually, I will start integrating it with Chainlink's infrastructure.
And on that note, in regards to data feed, right? One thing that's super important to you guys is just uptime, but also reliability, right? And when you guys did look at it with your data scientists, what was the average median absolute percentage error? Like we talked to NFT Bank and we talked to Spicefy, I remember, and they were able to get it down to, I think, less than 5%. So just curious, like what are the, like median absolute percentage errors that you guys are looking at?
By me, the average, do you mean like the deviation from the price?
Like when you back tested it, what was the sort of deviation from the price on average?
The way we weren't specifying the prices of individual NFTs, but rather we're looking at the like sales floor, like what was the lowest value the NFT would be selling at a certain point. Like it's kind of like trying to find the spot price of the collection. Because when we look at the floor, it's kind of like his ask price. There's like a spread between the price when the user is actually accepting those bids. So to answer this question, I think I would say like ballpark figure, like from the estimates of the actual NFT floor. So that deviation would be something like 7%.
Yeah, that's
like
awesome.
Around 7% to sometimes to 10% of the floor's value.
Yeah, I mean, that's pretty good, right? And especially since NFTs are so chunky, you guys have to stay at the floor. And also you guys go through this, pruning process of finding and taking out all these outliers. Like it's inevitable that there's some sort of deviation. And on note of that, I'm kind of curious if you guys have looked at the attack costs. For example, is there any method of filtering out like someone who stays within the bands and then just sells it to themselves back and forth and back and forth and back and forth to raise the price over time? Presumably so, like if the NFT especially has royalties and marketplace fees, this is incredibly destructive. But like, has that been something that you guys have tried to model, taking into account? And what is the attack cost there?
It just gets cheaper with the cost of, it's definitely a possibility. But like the price, for example, to manipulate Yuga Labs price. So user would probably need, can't really pull out exact numbers, but it's based on a sales volume that we have of the given collection on that particular day. So it would have to be maybe like at least 30-40% of the daily's sales volume to achieve it. And bigger collections can have like a few millions of sales volume.
Yeah, but I guess that makes a lot of sense. And what's important is that for any like noticeable collection with decent volume on drops, to do that, it would just be, you would hemorrhage money for marketplace fees, you would hemorrhage money for royalties, and you would barely move the price because of the sort of safety nets that you guys have in place.
Yeah, exactly. Yeah, so just do like rough math. So probably like it would cost just in royalties around 100K to move price for Bored Apes. But again, like there are two more price feeds that we're using, which are not correlated with sales, but rather with the floor and TWAP of NFTX Vault. So the price of moving that would be, I guess, much higher. In the end, liquidation mechanism, it won't account, it just wouldn't be profitable enough for them to perform that.
How does the liquidation mechanism work?
There are three cases. So first one is just when user has only one NFT supplied, and then user exceeds their borrow limit. So then NFT becomes liquidatable after borrowed amount is equal to like 90% of NFT's value. In other words, liquidator could obtain NFT at 10% of NFT value. So yeah, that's the first case. But in case like there are more NFTs supplied, so again, even when the user exceeds their borrow limit, so not all NFTs can be liquidated, just enough NFTs can be liquidated to cover the debt and restore the health factor. So if we have, let's say, 2 NFTs and 50K borrowed, then liquidator can do a repayment of, it's getting messy. we don't allow like to liquidate all NFTs, but only enough NFTs to cover the debt. If we have a case, we have two apes, both worth, let's say, 200K, and user has borrowed like 100K. So now borrower can repay 90K and obtain one ape, for 90K. So there will be like 10% discount. And then after liquidation, what we have is one ape worth 100K and a debt of 10K.
Maybe we can transition now a little bit into since I kind of interrupted you and started going there, was the how the interest rate works.
Yeah.
Possible to walk through the jump model?
Yeah, sure. So interest rate, it's more from the compound, and it has a higher multiplier, and the jump rate starts from 80% of utilization. So the interest rates range from 2% until 18% until jump model, and then once it gets higher, so then they can reach like up to like 60%.
And then are different types of collateral, I guess, handled differently? So if the supply is in ETH versus like USDC?
Yeah, actually, like both USDC and ETH, they have the same interest model.
Okay. Also, I'm curious about how is the kink in the model a constant? Or I guess like how is that determined?
Yeah, it's constant. It's 80%.
Is that something that could be voted on?
Yeah, totally. I think we're still very early at finding the optimal interest rate. So this is like the first model we had. And we've been trying basically to look what kind of interest would be optimal given like market conditions and given like overall borrowing costs at other platforms. So it's still like way cheaper than it is than peer-to-peer lending, and with time we'll be able to improve it.
I guess that kind of transitions into really, I guess, governance a little bit, and specifically, it probably makes sense to start with how emissions are distributed. The way I understand it, you lock DOP for VE DOP for voting. Maybe walk through, I guess, like how the emissions work with that. And I guess the purpose of that would have been to prevent like a governance to attack vector potentially.
We have this model where each lending pool can be incentivized by DOP tokens to basically help collections to attract more liquidity. And like our current like monthly emissions around 50,000 DOP. And each week we're doing a vote. Well, this week will be the first time we're doing it. So there'll be an ongoing voting process. And basically through the VDOP holders, we'll vote how much to assign for every pool. So the more votes pool receives, the higher share of rewards it gets. And the reason for why we implemented this VDOP model, it gets much more difficult to do governance attacks. Tokens can be just borrowed and used for voting. In the end, the value that's being accrued from the lending pools, it gets transferred back to VDOP holders.
From a more of a governance perspective, like what are some of the things that you guys would typically vote on?
So it's mainly like whether to list a particular pool or not. This is one like primary one that's happening on ongoing basis. Second one is changing the interest models, whether to increase, decrease, or change like parameters of the interest model itself. And then jobs distribution between lending pools and any other things related to the product, to interest rates, maybe like delisting assets or adding additional borrowable asset to the pool. So that also would go for it.
I do want to go back to NFT mortgages and composability. But before we do that, I went back and watched your interview with Gabriel Haynes. I think it was almost a year ago at this point. And I recall you saying that you guys are especially looking at metaverse items as a class of items, like game items, as collateral, somewhat like financing for industrial or active equipment, right? They have cash flow, so it allows for better pricing. I believe that was somewhere in their interview. How have you thought about implementing this? Because right? EIP 2615 is abandoned. And right now, if you put it in collateral at drops, you can't use it in the game. So like, what are the solutions there? And how have you thought that this will develop? And how does this affect the game itself?
The biggest issue is once NFT gets locked, it cannot be natively used within the game. And the only like possible ways around it is either like when NFT gets locked, so the issued receipt token should be usable within the game. So that means it's like more in-depth collaboration with the game itself, so that they accept that contract within it. And the second option, which is a bit more experimental, it's creating some sort of like Gnosis safe where user doesn't actually transfer NFT.
I think I get what you mean. So you transfer to a Gnosis safe. It's a multi-sig. One of the signatures is controlled by some automatic entity, and it knows when to sign off in the game. And then when you repay the collateral or when you repay your debt, then the multi-sig knows then to transfer it back to an individual's EOA.
Yeah, exactly. So it's like giving out this complete custody. Like one of the signers, it would be Drops Lending Pool. And there could be like whitelisted addresses where NFT can be transferred to be used within the game. So it can still be used. And then there would have to be many limitations of where NFT can be transferred and whether NFT can be lost in the game. So that's actually one of the trickiest parts. If user uses this in the game, what happens? Yeah.
This is definitely something I'm super interested in, right? Because you have the NFT implementation, which is just, project side integration. And then you have the rentable integration, which is like wrapper contract. A lot can go wrong there. And then you have the sort of EIP 2615 direction, which is, make like a whole new token construct, which itself is just going to be impossibly hard. And then like the last one you mentioned is the Gnosis Safe one, which, like prior to today, I hadn't heard of before. But yeah, that's super cool. I do want to go back to NFT mortgages. Like, how is this going to work?
It's actually built on top of our lending pools for the initial alpha version, like the way it works. So user chooses to buy NFT, let's say, from marketplace. This NFT would need to have a pool within Drops. So then user does like a down payment of like 60%. And then what happens, we initiate kind of like a flash loan. For the flash loan, we buy NFT from the marketplace, then deposit NFT back to the lending pool, borrow against it, or repay with this amount, the flash loan, plus with the initial amount that user has provided. Basically, user manages to get NFT for like half of its value from the marketplace. And after it gets repaid, he can claim it, start using it, or do whatever he wants. And while NFT is still locked in the lending contract, so it can still be used to like claim airdrops, for example. So it would be maybe like a good use case, like if someone thinks there's like a new upcoming airdrop coming in, so they can obtain a bunch of NFT mortgages, claim airdrop, and probably maybe repay with that airdrop that NFT they got, and have happy days. What I really like about it is that allows us to be more composable also with marketplaces. Well, NFT marketplaces, that's like primary place where NFT collectors just hang out, look for things to buy. So from marketing perspective or user acquisition perspective, it's also a big win because we can leverage integrations within marketplaces to get more loans. And it's also a win for marketplaces themselves because it helps them to increase sales volume. So their revenue goes up, numbers go up.
Maybe what we do now is zoom out a little bit and just talk more general like NFT finance questions. So I was thinking in the context of Drops DAO, just be curious how you view really just the difference between the peer-to-peer models and peer-to-pool.
Each of these models has its own strengths and weaknesses. So with, I say like the biggest strength of peer-to-pool model would be that it creates much better composability, and it can allows users to obtain like instant permissionless loans. Whereas with peer-to-peer, then you would always need like a second counterparty for the approval. So that's how NFT mortgages like could be possible. They're possible now with P2Pool model, because we already have NFT value estimated by the Oracle, and so there's lenders willing to finance the NFT or to back the NFT, and it just creates less friction in development. It can be integrated with other protocols, and also like what can be built is like NFT vaults, mortgages, and perhaps something else. I don't know, maybe like leveraging long NFTs or potentially shorting with fractions. So those are the advantages for peer-to-peer. I would say it has higher capital efficiency for lenders, because we add additional variable there, which is time. So we can have shorter loans, higher interest rates, longer loans, lower interest rates. If we compare with the interest rates between two of these models, so peer-to-peer model gives lenders an edge with interest rates. However, in case of like insolvency or liquidation, so lenders need to basically accept the NFT they had provided the loan for. While with peer-to-pool, there's always a room for pulling out liquidity. It gives, I would say, like it gives more than freedom of movement for the assets as well. If we summarize it, so peer-to-pool just offers better composability, and then peer-to-peer offers higher capital efficiency, allows lenders to earn more in the short term. But what's better for users? It's probably like the speed still matters, and lower interest rates, everyone likes them because you can just do much more than with your spare capital. So these are my thoughts of it.
Yeah, that makes absolute sense. And that's sort of roughly around how we're thinking about it as well, right? Better utilization rate for lenders, but at the cost of, potentially having to hold an asset during liquidation, which might not be great. Like if you were holding it today versus, in the peer-to-pool model as a borrower, like I get instant loans, but as a lender, there's less utilization potentially. There could be 100%, but then, there are some positives of not having to hold the asset and liquidate it myself and sell it myself and like that. To end the podcast, I do want to ask you, just like NFT finance as a whole, me and Helmus, like we're super excited about it. But what caused you to build in NFT finance, and sort of like as an ending there, like what do you see for NFT finance as an industry in the future?
Well, I think like we're heading towards tokenization of everything. So right now what we have is profile pictures or metaverse assets. Is just a scratch of about what is about yet to come, because NFTs wouldn't be just limited, like to metaverse assets. It's essentially like certificates of authenticity for any asset. So things like, I guess, like housing mortgages or loans or real world items. So all of that eventually can be tokenized for like middlemen, brokers towards NFTs, and can get plugged in to the whole crypto ecosystem. As thoughts on the NFT markets, I think we start seeing like more and more products coming out, and it's just really exciting to see how once these like illiquid assets start getting tools which make holding them or working with them more exciting. Those would be, I guess, my thoughts. That are still early, and there are exciting things that will be built and exciting things that will be tokenized as well.
Yeah, absolutely agree. And just on an ending note, like thank you, Darius, for being here, and we really enjoyed our conversation. But to end it off, like how can people get involved in Drops? Where can people find out more, and how can people contribute?
So just to start, this is our website. It's drops.co. And also like follow us on Twitter, Drops NFT. And to get started would be just joining our community or on Telegram or Discord. And like if there are like any questions arising, I'm always there to answer. And we'll be happy to see you guys. Also, we're going to NFT NYC. If anyone will be there, we'll be happy to say hi.
I'll be there, so we'll have to sync up.
Yeah, for sure.
Cool. Yeah, definitely. Really, to echo what Terry just said, really appreciate you coming on the show. And again, everyone, just go check out DropsDAO. Take care.
Thank you. We're grateful for your invitation, and hopefully we'll catch up at New York.